What if I told you there's a 3-digit number that affects every aspect of your financial life, forcing you to pay hundreds, even thousands more on things that we all need like housing, insurance, transportation, and utilities? Now what if I told you that this number follows you your entire life, rewarding or punishing you for decisions you made when you may not have known any better? This is the reality of your credit score. A 3-digit number that could be costing you thousands and denying you access to the better life that you deserve. I've raised my credit score from an abysmal 530 to over 800, which by credit standards is as good as it gets. And in this video, I'm going to give you the bulletproof playbook to raise your credit score and save hundreds of thousands of dollars in the process. First off, why does your credit score matter, and why should you care about it? Great question. Put simply, your credit score is one of the key factors that will determine whether or not you're able to build wealth or remain in a perpetual state of struggle and hardship. A low credit score will make it nearly impossible to buy a house, which is one of the most common ways to build wealth. Not trying to buy a house because the market's been crazy? I get that. Unfortunately, a low credit score can affect your chances of renting a place as well. It's not uncommon for landlords to run the credit of their prospective tenants, not only to look at the score, but to check for derogatory info such as charge-offs and repossessions. Blemishes on your credit report could result in you having to pay a higher security deposit or getting your rental application denied altogether. This is just one of the most serious examples, but there's a ton more. A low credit score could affect your ability to buy a car, get a credit card, set up utilities, get insurance, and even get a cell phone. Often, you'll pay considerably more for those products and services due to high interest rates and extra fees. And with interest rates the highest they've been in over a decade, you can't afford to let companies overcharge you due to your bad credit. This is a trap that a lot of us fall into, and I'm definitely no exception. I remember when I got my first car, a white Toyota Corolla. My credit score was like 530 and somehow I managed to get approved for a loan, but it came at a cost. A soul-crushing 25% interest rate. For context, the average interest rate for an auto loan is around 5%, so I was literally paying 5 times the interest that I should have. The base price of an entry-level car in the US is around $25,000 after taxes and fees. That means if you wanted a 60-month loan term with a 5% interest rate, your payments would be around $471. With total interest being paid around $3,300 over the life of the loan. Add all that up and the total cost to buy the car would be around $28,000. Now, let's do all this with a 25% interest rate. This is where things get crazy. The payment shoots up to about $733, and the total interest jumps to over $19,000, bringing the total cost of this $25,000 car to over $44,000. To make matters worse, a lot of auto manufacturers offer as low as 0% financing for qualified buyers, which means you're potentially missing out on tens of thousands of dollars in savings. Now at the time, I needed a car and I couldn't afford to shop around for a better deal on financing. This is all too common for people who have bad credit. Maybe you're in the same spot, which is why it's all too important to get your credit together ASAP. So let's talk about your credit score and factors that affect it. A credit score is a number between 300 and 850 used to determine how likely you are to pay back your debt. With this number, lenders can figure out whether you're a high risk or a low risk borrower and whether or not it makes sense to lend money to you. You actually have not one, not two, but 3 credit scores as your credit report is tracked by 3 companies. These companies are Experian, Equifax, and TransUnion. Other names for your credit score are your FICO score or your Vantage score, but these are just models that are used by lenders to calculate your score and assess your likelihood of default. While each model has slight differences, your score is unlikely to be vastly different across the board. Factors that affect your overall score include payment history, credit utilization, length of credit history, types of accounts, and recent credit history. While all of these are important, each of them holds different weight, which is what you can use to your advantage to quickly and efficiently raise your credit score. The first and most effective step in improving your credit is cleaning up your payment history. Accounting for 35% of your credit score, your payment history is the single greatest factor in achieving a high credit score. Late payments or non-payments can sink your credit score and result in you getting denied for vital loans. To start fixing this, go to creditkarma.com and view your credit report for free. I use them myself to track my score and their services have been a serious help to me. You can honestly use any service you like, but you need access to your report and not just your score. Once you have access to your credit report, you need to check it to make sure that all the information on there is correct. About 1/3 of Americans have an error on their credit report, so you could fall into that category. This is an easy way to get some points back. If you find errors, you're going to need to dispute them online or write a letter to the 3 credit bureaus to dispute the information. The Federal Trade Commission has provided a sample letter, which I've linked in the description. I send this letter to both the credit bureaus and the company misreporting the information. If you check your payment history and there's legit derogatory information on there, you've got a few options. For late payments, you can contact the company that reported it and ask if they'll remove the late payment from your report. Often if you have a single late payment and you continue to do business with this company, they will remove it in good faith. I've personally done this and it's worked out really well in getting the late payment removed. Unfortunately, non-payments are a little bit trickier. If you have an item on your credit report that went to an outside agency for collections, you often have little choice but to pay it. And trust me, you want to pay it. Unpaid debts on your credit report can be re-reported, meaning that the debt will continually drop your credit score unless you take action. On the flip side, debts will show as paid in full on your credit report if you paid them off, and over time, they'll actually fall off your credit report. This happened with me when I paid all my past due debts and saw my score creep up. A tactic you can use to expedite this process is to attempt to bargain with the collection agency. Often these agencies want to settle your debt as quickly as possible, and if you agree to pay the debt in exchange for removal of the derogatory account from your credit report, they'll often agree. I didn't know this when I was settling my past due debts, but I was able to use this negotiating tactic when I was cleaning up my wife's credit report. Regardless of how you approach it, checking your credit report for accuracy and settling your debts is the most effective way to build your credit. And speaking of building, I started this channel to help you build a better life for yourself and those you care about. So if this information has been helpful, go ahead and tap that like button and subscribe for more content. This channel is here to help you level up and gain better control over your life. Thanks in advance. The next step is lowering your credit utilization. This is the second greatest factor in calculating your credit score, accounting for 30%. Credit utilization is the amount of available credit that you're currently using. Typically, this is linked to credit cards and how close you are to maxing them out. To get your credit utilization ratio, or CUR, add up all your credit card balances and divide that by the total credit limit. For example, if you had 3 credit cards and your credit limit was $2,000, $3,000, and $5,000, and your balances were $1,000, $2,000, and $0, all you have to do is add up those balances to get $3,000, then divide by the total credit limit, which is $10,000. This would give you 0.3 or 30%. A good utilization is below 30%, and a great utilization is between 1 and 10%. Why not 0%? Because lenders want to see that you are actually using your credit cards and using your credit responsibly instead of avoiding it altogether. So not using your cards at all could potentially hurt your credit. A low utilization tells lenders that you're responsible with spending and you haven't overexerted yourself. A high utilization, on the other hand, means that you're either in financial trouble or you aren't very responsible when it comes to credit. I had multiple maxed out cards at one point, and not only was it killing my credit, but I was drowning in high interest debt. There's really only 2 ways to solve the utilization problem. Either pay down your debt or increase your credit limit. If you're close to maxing out your cards, or if you already have maxed them out, your best bet is to just pay down the debt. But one thing I was able to do was get a personal loan at a lower interest rate to consolidate all of my high interest debt. This actually lowered my credit utilization on my credit cards and it improved my credit. I was also able to request a credit limit increase, further lowering my credit utilization and improving my credit score even more. This technique could work for you, but be mindful that if you are able to make this happen, do not repeat the behaviors that put you in this credit card debt in the first place. It's just going to hurt you further down the line and put you more in the hole. Also, make sure your income can support a personal loan, as due to the shorter loan term, your payment tends to be a lot higher than what it would normally be if you were just making the minimum payments on your credit card. Next up is length of credit history. This is basically what it sounds like. Your length of credit history is how long you've had your accounts, and this accounts for about 15% of your overall score. There's honestly very little you can do to help this, but there's plenty you can do to hurt it. After 7 years, most negative items fall off of your credit report, and as I mentioned before, the clock starts once you've settled your past due accounts. There's also a factor known as average age of accounts, which is the average age of your credit card accounts. Every credit card you open lowers your average age of accounts. On that same note, every old card that you close lowers your average age of accounts. I'm not saying don't open a new credit card, especially if you're trying to build up other categories like utilization. Just be mindful of those cards that you're opening and what impact it could have on your credit score. Next is type of accounts, or credit mix. This has to do with how well you can manage different types of accounts, and it comprises 10% of your score. Credit cards are considered revolving accounts, while auto loans and mortgages are installment accounts. There isn't a lot to do here either, but as I mentioned before, if you have a lot of credit card debt, you could get a personal loan and pay down that balance, and this in turn will give you an installment loan and add to your credit mix. Personally, I noticed my score starting to creep up about 6 months after getting a mortgage on my first home. Next is new lines of credit, or credit inquiries. This accounts for 10% of your score, and it looks at recent accounts that you've applied for or opened. Every time you apply for credit, it shows up as an inquiry on your credit report. Having too many inquiries on your credit report communicates that you may be trying to overextend yourself or taking on too much debt at once. There's two types of inquiries: hard inquiries and soft inquiries. Hard inquiries are the ones that you need to worry about because they're the ones that affect your score. These can include applying for a new installment loan, applying for a new credit card, applying for utilities or a new phone service, and even a rental application. Depending on the company, however, sometimes these inquiries aren't reported to the credit bureaus. When applying for anything that requires your social security number, make sure you ask if your credit will be pulled and if it counts as a hard inquiry. Inquiries stay on your report for 2 years, so try to limit the number of inquiries to those that are absolutely necessary. The exception here is when applying for an installment loan like a mortgage. It's expected that you'll shop around for an auto loan or a mortgage, so as long as all of those applications are within a 45-day period, they'll all count as one inquiry. As I mentioned before, a really easy way to hurt your credit is by taking on too much credit card debt. But there's also other credit card mistakes that could set you back significantly financially, which I talk about more in this video here.